This is a special podcast presentation from 700WLW.com. This is Casey Boland on Demand.
Joined by Casey Boland of Hengel Capital Management. And Casey, this is sort of a bugaboo of mine, the difference between what's average and what is normal. I notice this watching the weather sometime. They'll say the normal high for today is 85, when in reality the average high for today is 85, and maybe it's only been 85 twice in the last 30 years. And the same goes with money and returns in the market with regard to the difference between average and normal.
Yeah, you're right. I mean, if you look at the summer, we've had temperatures in the 90s, some fantastic temperatures recently, nowhere in the norm on either end. And, yeah, you look at interesting stat recently with the S&P 500. It has crossed the 2100 level to the upside 25 times over the last 18 months, which means that the market really has gone nowhere during this period of time, where the market over a long period of time has averaged between 9 and 10%. But we get these returns sometimes where the market has great spurts. It doesn't do much like it's doing right now, and it can make investors feel fidgety during these periods and very frustrating.
So look at just since the beginning of this millennium, we go through 2000 to 2002. Just give me a few incremental sets of years.
Yeah, during that 3-year period, the market was down 37%. The next 5 years through 2007, it was up 82%. Then 2008, we don't want to have that memory again, down 37%. Recent years, 2009 to 2014, up 156%. And now recently, through 15, through part of 16 here, up 4%. You know, the patterns look very similar going back to 1929. But, hey, I'll take that average return of 9.5%. But there have only been 2 calendar years since 1929 where the market returned anywhere close to that average between 9 and 11%.
That's funny. So, again, that might be average, but it's hardly normal if it's only happened twice since the 20s.
Yeah, that's not going to be the normal experience. Returns are lumpy. You're going to get losses. You're going to get great gains. You're going to have periods where it's going to be very dull. There's going to be gut-wrenching losses sometimes. The market's inconsistent. You just have to get used to it. There are always going to be good reasons to not like investing in the market, but those who can handle the inconsistency, they will be rewarded.